being CEO of the Insurance Council means that every few weeks you front up to the board and they grill you and ask you a whole bunch of questions. So just occasionally the tables turn, and today is just such an occasion. So on stage we have 5 of the ICNZ board members, and each one of them is going to speak on a, hope this is going to work so we can get to, hopefully that's going to change shortly. So none of them probably need any introduction, but we'll go through that. So we have Jacki Johnson, Chief Executive of IAG, then Martin Kreft, Managing Director New Zealand of Munich Re, Cris Knell, Chief Executive New Zealand of AIG, I've got to get that right, haven't I? Chris Black, Chief Executive of FMG, Farmers Mutual, and at the end there, Curtin, AA Insurance. So can you just welcome them all as they come on stage. I am hoping that we've got a couple of yeehaw. Great. So we're going to ask them to speak up to 7 minutes on these topics, and I'll come to the second slide for the other 2 speakers. What we're trying to do here is draw together some of the themes that have come through during the course of the day. So first of all, Jacki is going to speak to us about attracting new talent to the industry around also the context of the reputational issues that we are faced and challenged with. Chris Knell will look at the multiple regulatory environment in which AIG operates, and perhaps the learnings that we have as we move forward from September 7th and the full licensing regime under the RBNZ. Curtin will look at that issue around affordability of insurance, and then we're going to pass over to Chris Black, who will try and draw together a viewpoint from the perspective of a New Zealand-owned mutual, looking at issues around regulatory issues, affordability, reputation, and all the other issues that have been addressed by the previous speakers. And finally, Martin Kreft will give us a reinsurance perspective around whether New Zealand is perhaps too small to count, or whether we are going to look forward to greater support in the future from reinsurance. So can I welcome to the podium Jacki Johnson.
It's really apparent to me that we've had feedback all through today, that today's conference has really been quite uplifting about bringing together a lot of the enablers in terms of capital, giving an insight into the political landscape. Leanne really brought home to us what we're really here for when she brought the voice of the customer to the table today. But the one thing that has been missing all day is really the conversation about our people, and the people that we need to continue to attract into our industry to be able to meet the challenges that Robert really brought to life, and also to make sure that we continue to be able to deliver in a complex global market and here in New Zealand. And I think what becomes really challenging for all of us is there's so many of us in this room that didn't choose insurance as our first part of our career. It's often been a second or third segue of our career. And yet what we need to be thinking about is how do we become a really strong employment brand together, and as our own individual brands as well, and how do we actually help link that to people who are leaving school and actually joining our industry. And I think when I often get asked to talk on the topic of diversity, and it's pretty obvious because I'm a female CEO, and I'll often say, well, I will only talk about diversity if we talk about diversity of thought. Because actually having more females in our industry that is just like everyone else but not really facing what the problems are of the future and coming up with the complexity and diversity of thought won't meet the challenges of the future. What we do need to do is make sure that our diverse workforce collectively meets the needs of all our stakeholders and are representative of that. And I want to share with you just a short YouTube clip that we've got of new people to our industry. And I think last time when I was on the podium last year, I talked about how I'd crowdsourced some views on LinkedIn about what people thought about working in our industry. And they were probably from more of us in the industry that's been around for a long time. So this year I thought I'd share with you the views of our new graduates who's been with us for a year and who had never thought about working in insurance. And I think it'll be a fairly uplifting way of starting the panel to say, actually, we do have a great purpose, we do have a great reputation when we sit and think about it, and let's not get always skewed by the biased reporting we might see or when we've all had tough days. So with that, I'll just share, if it works. No, here we go.
I work as an actuarial analyst. I'm part of the actuarial team.
I like problem solving.
Find out what the business needs are and then communicate them.
My job is to do the testing for this system.
I was quite insurance focused.
I studied finance and computer science.
Information system from my bachelor degree.
I originally enrolled in a Bachelor of Arts in Psychology.
BCom, Bachelor of Commerce with honours, majoring in economics.
A Bachelor of Commerce and a Bachelor of Science with honours.
And I always wanted to work in the finance industry.
I did a paper in calculus and had a really good lecturer, and that kind of just took my heart.
I wanted to be part of a graduate program where I had mentoring, that's the main thing, and a direction to what I do.
IAG really invests into our learning.
You're young and starting out. It's good to know that within a company,
You have a work-life balance and they want to develop you.
if you really like that company, you have all these opportunities to go different places.
So the training is done as you work.
Easy culture,
Friendly environment.
Contribute my skills.
multinational, but still felt like it was home in New Zealand.
I was targeting at something like this ever since I graduated.
Because I like how I'm being challenged on a daily basis.
IAG has great people culture.
It's New Zealand's largest general insurer.
It's a really nice place to work.
It feels like a little community.
Whenever you need help, everyone's willing to help. No matter where you go in the business, no matter what level you're on, you can just ask someone.
They really care for each and every single individual in here.
Embracing it and enjoying it.
It blew my mind away pretty much.
I think the interview process is awesome. It's really good.
Had a nosy around the company's website. They sort of asked you about you, what you'd done that day, what you do as your hobbies. Like state insurance, AMI, NZI, Lantern.
The interview process showed me what a really good company this was.
So it felt really personal.
It was really friendly and the role seemed to really fit what I'd been studying.
I was totally impressed.
So that set it apart from other companies for me.
So IAG has really complex and complicated system, for test.
The transition from study to work has been made really easy.
It's busy and it's fun.
The most surprising thing for me has been how dynamic insurance is.
For me at least, as being a graduate, I'm learning so many new things every day.
When I first time work to the fifth floor, and I say, oh, so many people there.
No single day is the same as any previous.
It's constantly changing.
Very important being a graduate that you have a solid foundation.
That's the key reasons I choose IAG.
So be open to learning new stuff and always ask questions.
There's probably no better companies out there to work for.
It's the place to be. You'll be fine.
So I'm showing that not to do an ad for IAG employment today, because knowing our brand confusion, you'll probably pick up the phone to Cris. But I show it because it highlights the need to attract diversity and from skill, and you heard all the professions that we actually employ in our industry. When you look at the diversity of ethnicity of our graduate program, and when we think about what Auckland alone is going to become by 2030, and also to hear vibrant conversation about people being in our industry for a year and what they've found it to be. And it's a bit of a hint of us as leaders, how we have to role model our industry. And in fact, imagine if we went to our customers and our customers actually used those exact words about dealing with us and what it was like. That in itself would solve our reputational challenges, and I think that's the challenge for all us as leaders. How do we put our own people and our internal cultures together with the reputation we're starting to build? And on that note, I'll hand over.
Thanks very much, Jacki. Obviously, the people in the industry are core to the success of it, and so that's a really important aspect for us to look at. We touched earlier on in the day on regulatory matters, and Knell is now going to talk to us about the lessons that can be learned from operating in multiple regulatory environments. Chris.
Thank you, Tim. I guess I picked the best subject out of the lot, so that's fantastic. Look, it's kind of a cliche, but the world today is more connected than it probably ever has been. We know how critical it is for an insurer to not only build a business, but to build a stable business and also to have stable capital backing that business so that we can ensure that our clients, our customers, are able to rely on our support should they hit any mishaps in the future. As well as the greater oversight that we're seeing from the regulators, not only in New Zealand, we're also seeing them in other parts of the world. And as I've looked into this subject more deeply, we see that the regulators in parts of Asia now are starting to really step up as well. And in fact, Jeff Mortlock mentioned, that the regulators are really starting to get active, and just as our industry needs it, we have a new welter of acronyms to deal with as well. So the International Association of Insurance Supervisors, the National Association of Insurance Commissioners, we now have strategically important financial institutions, we have globally systemic important insurers, and the one that's probably most fitting for this environment is a confusion between Jacki and myself, which is now an IAIG, which is an Internationally Active Insurance Group. It's quite confusing, but you can see that the differentiation between how the regulators around the world are dealing with the institutions is a little bit confused between what an insurer is and what a bank is. And there's a real issue there that needs to be resolved. How do I deal with this? That way. There we go. So if you look at AIG, we were kind of a poster child, I guess, for the financial crisis back in 2008, and once described as the largest and most complex insurance entity in the world. Well, today we've slimmed down and we're more focused, but the P&C company is still $34 billion in gross premiums as part of an overall group that developed $65.7 billion in 2012. We've got 90 country operations, or 95, depending on who you speak to. We've also got business in about 130 countries, and we touch about 88 million customers around the world every year, 200,000 commercial enterprises, and 98% of the Fortune 500 companies. So you can imagine with that kind of footprint that we have a lot of regulatory people chasing after us for detail, for capital adequacy, for how we're running our business, for fit and proper investigations into staff, structures, risk management, and what have you. So we deal with this on a global basis, and it really is the only way to keep this with some sanity. And if you look at the picture of why the regulators take such an interest in the insurance industry, you'll see that in New Zealand alone, the past 25 years have seen dramatic changes in the New Zealand insurance market. We've seen a lot of consolidation in this market. And we know that there's a lot of complexities in writing business in a cat market. But we also need to be absolutely assured that the insurers who are representing policyholders have both the financial strength and the depth of resources to really meet those covered claims in future. It's important that we're committed to the market long term. And it's also important that the policyholders have confidence in that market. And that confidence is absolutely paramount to future success, and it can only be cultivated through a healthy oversight of an independent regulator. If we look at the marketplaces around the world, and unfortunately these are some of the casualties that we've seen, it's not new for us. There were two reports that were generated in 1999 and in 2002, the Sharma report to the EU Commission in 2002 and the AM Best report on failures of American insurance companies. And in the American case, out of 426 insurance company failures between 1960 and 98, 269 were as a result of under-reserving or rapid expansion. And in the European case, the causes were absolutely well known to us. They were under-reserving, poor forecasting, rapid expansion with underpricing of exposures, over or under-reliance on reinsurance, catastrophic losses, fraud, or investment failure. So the regulators have got a menu of insurance companies that have failed, and they've also got a menu of why those insurance companies have failed. And so what we're looking at as a new world order is this kind of structure for our company. So we've actually got 4 tiers of regulation right now. We start off with the RBNZ. We then go up to parenting in Singapore. So our subsidiary in New Zealand is parented in Singapore. So we have the MAS, the Monetary Authority of Singapore, overseeing that. And then we go up to the next level, which is the US state insurance regulators. And then finally, AIG, which is now considered one of the 9 global SIFIs, is now overseen by the US Federal Reserve. I have to say, SIFI, the hit list reads like a who's who of world insurance, except that everybody outside this particular club is not actually clamoring to get in. Historically, the US regulators have been running on a risk-based capital basis, but we've now got this new Dodd-Frank Wall Street Reform Act and Consumer Protection Act, which will likely impose more capital standards on insurers. And at this moment in time, we don't know whether those capital standards will sit alongside the state insurance regulators' capital standards or whether they'll be on top of that. There's not a lot of clarity on how this is going to work. Suffice to say that the International Association of Insurance Supervisors has released on the 17th of October a new thing called a common framework, which has got a consultation deadline on the 16th of December. So they're trying their best to get some sanity into this process so that we can all understand what that future roadmap on regulation is really going to look like. I just want to make a couple of comments on ERM. It's a very busy slide, so I'll just paraphrase a little bit. But in 2009, the OECD criticized insurers, saying that risk is not managed on an enterprise basis and is not adjusted to each corporate strategy. They were likely spot on, except that most insurers did have some kind of plan on risk management. It just wasn't evidenced. So what we're looking for really is more granular analytics, and we're looking for a more forward-looking management function. And as Warren Buffett so eloquently put it, if past history was all there was to this game, the richest people would be librarians. We've got to see ERM not as a compliance issue. We have to see it as not a tick box issue. We've got to see it as a benefit, a strategic tool that can drive the business and also add significant value. We know that the rating agencies are taking absolute note of this right now, and that as the rating agencies take note of strong and solid ERM practices in insurers, they will likely give them higher ratings, and that in turn should offset some of the capital costs. That's the hope. And if I just go through some of the problems that we have here, we've got a balancing act between the regulators and the marketplace. That's natural, and that stress has been in the mix for a very long time. But the absolute challenges of regulation are that there's a sheer volume of new regulation which we have to work through. It's time-consuming and complex. We need skilled people in very specialist areas to be able to work through this. There's an uncertainty out there until we get a framework which everybody kind of understands. And if you look at the reasons why that's a concern to insurers, I think you can see that if the capital is actually challenged, we can actually either postpone, delay, or actually shelve investment in our business. We could consider raising premium levels, which is not a particularly good competitive stance. We could drive down commission rates, which would be incredibly popular with people like Robert. Or we could seek to drive efficiencies through offshoring some of our low-level admin and risk analysis work to shared services environments. There was a question earlier about whether this created a competitive edge for smaller companies. I would actually say probably not. It might do in the very short term, but if we look at the issues that Robert mentioned with Lloyd's, there's a scale about these big companies where they should be able to bounce back from this and create value. And the last point I'd like to make is about the banking and insurance regulation. There's a real need to differentiate this. We've got people like Alan Greenspan, who was absolutely against regulation in banks. He said recently, and it's quoted in Time magazine, he said, "I was wrong. You have to regulate the system. My concern is that it's more vindictive than curative." And at present, because we have no global regulator, there's no such thing as global solvency or global bankruptcy. We don't have a legal requirement for global bailouts either. It's very difficult to see how we can piece this all together unless the IAIS can actually bring the regulators to act in a more common way. We should also remember that throughout history, the wind down of an insurer has never caused a systemic financial crisis. My recommendation, and certainly the way that AIG responds, is that every insurer should be well advised to engage with the regulators wherever they do business. They need to negotiate, they need to discuss, they need to ensure that they're all over new policies and that they're ventilated properly through the appropriate channels before they become policy. And as far as the 1 in 1,000 capital cat charge is concerned in New Zealand, I think that actually as soon as we get a little bit more data on cat risk in New Zealand, particularly on liquefaction and business interruption, that we'll have a really strong platform to go back to the Reserve Bank and negotiate that to a level where it's appropriate for the risks that we're facing. I think it's important not to overreact. I think it's also important to continue dialogue. I think we must make sure that the regulators aren't armed with a solution that's looking for a problem. And I think clearly the common objective is that the medicine that we provide here does not harm both patients, either the insurer or their policyholders. And by demonstrating strong ERM and open dialogue with our regulators, we could actually, in Alan Greenspan's words, we can have a more curative than a vindictive outcome for the industry. Thank you.
Thanks very much, Cris. Balanced regulatory policy, obviously absolutely critical. And one of the, if you don't get it right, of course, it just adds to cost. And that brings us to our next speaker, who's Curtin, who's going to be talking about the affordability of insurance, an issue that is dear to all our hearts and our customers. So,
thanks, Tim. Good afternoon, everybody. Thanks very much. It's a privilege to be here to talk about this subject. So there's two parts to it. The first part of the question is the affordability of insurance an issue and what's contributing to it? And probably the more complex part of the question is how do we go about making insurance more affordable? So if we start at the beginning and deal with the first part of the question, yes, absolutely. In our view, the affordability of insurance is a really big issue for New Zealanders. And I think if you think about the impact of the Canterbury earthquakes, I think it becomes clear why. So when, and I know this was discussed this morning, but when an event causes insurance losses that amount to 20% of a country's GDP, as the Canterbury earthquakes did, the impact on affordability of insurance for that country's consumers is going to be significant. Reinsurance premiums, as we know, have increased massively after the earthquakes, and the EQC levy has tripled. And while we in the industry have an understanding of all the inputs and the moving parts, we have to get into our customers' shoes to view it from their perspective. For example, at AA Insurance, the average cost of insuring a home, including all levies and taxes, is now $950. Of this amount, $650 goes on reinsurance, EQC levies, fire service levies and GST. Put that into perspective, before the earthquakes, our average premium was $560 and about $240 went through us to reinsurers, the EQC and the government. So that's a 69% increase in the cost to our customers. Over the same 3-year period, wage inflation has run at just 7%. And the impact, of course, is worse for those people who are on fixed incomes. So I found it interesting this afternoon listening to David Parker talking about the motivation of their party to consider another competitor called Kiwi Assure. And if you think about those figures that I've just talked about, and you try and understand what that policy might do, is it there to increase competition and therefore drive costs down? Think about the component parts of that cost and understand the reality of extra competition actually having an effect on that. So if I turn my attention to the second part of the question, which is far more complex, how do we make insurance more affordable? I am going to focus on home insurance because that's where most of the current affordability issues and problems lie, although they do cut across other forms of insurance. And I know this morning during the session we heard about New Zealand being a very highly insured society, and we have to make certain that this remains the case, because if fewer people insure in the future, the cost for those who do will increase further. So we do have several parties with significant roles to play in affordability, and I'll start with reinsurers. We need to work with reinsurers to keep insurance available and affordable. And the change to the sum insured cover is a really good start, and we need to find more opportunities with reinsurers. The government and regulators. We need sensible regulation that delivers confidence for consumers without increasing costs. And we also heard from Leanne Dalziel earlier on this afternoon about, I think one of the comments that she made was from one of her constituents who talked about a suburb that basically should never been built on. Building codes need to promote resilience without going over the top. We need national and local government to prevent building on land that's unsuitable, unfit for purpose, or puts homes at high risk of damage. Local government needs to play a greater role in risk mitigation to protect their communities from issues such as flooding. And given the issue of climate change, claims costs will go up if the authorities don't do more to proactively protect their communities. We turn to levies. Levies must be charged more equitably. The fire service levy needs a rethink. It's unfair to place the burden solely on insured people when the fire service is accessible to everyone. For homeowners, the fire service levy could be added to rates, and car owners could pay for their levies through vehicle registration. That would be fairer. EQC levies are different because only the insured receives EQC cover. EQC levies need to maintain the Natural Disaster Fund and EQC's reinsurance, but they must be reviewed regularly or big jumps in cost will result like the tripling we've just seen. The review of the EQC Act must support the continuing availability and affordability of insurance as a primary objective. And I just want to talk about consumers for a minute. So our customers play a pretty important part in what we do. Of course, no one should buy insurance on price alone. Having the right policy coverage from a financially strong insurer must come first. But if these things are similar, then consumers should shop around and they should compare premiums. I tell my family and friends they should always shop around. At the moment, consumers are not playing their full part in driving competition, in my view. It's astonishing that at a time when insurance premiums are at their highest ever, only about 1 in 8 people switch at renewal. People are not shopping around for the best offer, and in some cases, bundling works for people, and in other cases it doesn't. They can get a better deal if they split their insurances up. So if consumers took more control, were flexible and talked more to insurers before buying, there would be a knock-on effect on competition and premiums. And as insurers, we have to manage our claims costs and our expenses. We need to be always looking at ways to improve our productivity. We need to become more efficient. And yes, the use of digital technology to buy, renew and make claims is in its infancy in New Zealand. But from our experience at AA Insurance, a significant proportion of quotes that we do is done online, and a significant number of policies are bought that way. It does reduce cost and offers customers speed and choice, but it's not necessarily the panacea. Many consumers will still prefer talking to a person, but we do need to allow our customers to interact with us in the way that they choose. And digital will provide many people with more flexibility, and it will help to keep costs in check. And from an insurer's point of view, our profits must balance the need to hold strong capital reserves and provide shareholders with returns that reflect their risk against overburdening our customers. Our premiums are under scrutiny and we have to get them right. Finding the equilibrium between sustainability, consumer protection and affordability must be at the forefront of our minds. And finally, insurers need to get much better at communicating. The earthquakes have resulted in a general and unfounded mistrust in insurers, which we have to remediate. We need to win back the public's trust, and we need to work more closely with, for instance, the Commission for Financial Literacy and Retirement Income to increase the public's understanding of insurance, because some people have lost sight of the value of being insured, and they don't realise the consequences of not being insured. And it would certainly help a lot if the media focused on the 99%, not the 1%. There is greater need for more balance and less controversy. Yes, the recovery in Canterbury is taking time, but homeowners who had insurance are much better off than those who didn't. And it's up to us as insurers to get the message out there. Simply delivering great service, paying claims promptly, and advertising is not enough. Now more than ever, we need to demonstrate the value in insurance, show why it's important and what it can do for people when they need it. Thank you.
Thanks very much, Cris, for tying together very much a holistic answer to that question, where everybody in society, to one degree or another, from government, local government, insurers have a role to play around affordability as well as the consumer. I'd like to now introduce Cris Black. Cris Black is the only one on stage who runs a wholly New Zealand-owned insurance company. It's a mutual, and we've invited him to talk about the issues of recruitment, reputation, regulatory risk, affordability from the perspective of a New Zealand-owned mutual.
Thanks, Tim. I don't have any flash videos, but I am going to get one of those tall, skinny cameras that you've got at IOG. That looks very good, Jacki. I'd like to just share a perspective from the mutual insurer's point of view. Mutual and cooperative insurance organisations are different. They're not better or worse, or more or less, they're just different. And one of the fundamental differences is that our stakeholders are different. So in a lot of businesses, in a publicly listed business, you have employees, you have customers, and you have shareholders, and they're often different people. In a mutual, your policyholders are your customers and owners, and you have employees. So in that sense, it's a closed system, which in some ways makes it easier than an open system. Globally, it's interesting if you look at the share that mutuals and cooperatives have of the global insurance industry, it's about 5.5%. And in New Zealand, it's about 5.5%. The percentages are slightly higher in Europe, about 8.5%, and Asia is quite high as well, about 7%. And those countries today that are well underinsured, mutuals and cooperatives play a very important role in TACAFUL insurance is what it's called, and microinsurance, setting up new schemes that are a little bit different, again with closed systems where people pay into a fund that they own and they get support from when they need it. Mutuals are also quite prevalent in the agricultural sector. So as you look around the world, a lot of agricultural insurers are evident with the mutual. I suppose strategically, mutuals, they tend to have a very clear purpose, again because the stakeholders are in common with ownership and the client. It's very important, I think, for mutuals to be particularly clear about where you want to play and how you want to win, because the mutuals don't tend to be as big as non-mutuals. So you've got to be very clear about target markets, clear about propositions, clear about your execution, and you tend to have a long horizon, and that's important. The stakeholder management, I think, is probably easier for a mutual in a funny way than, colleagues here on the right, because we don't have analysts all over us all the time in a quarterly earnings cycle. We can take a longer term view, and to us, that's having worked for NAB for a long time. I must admit it's actually quite a relief not to have to deal with that. And you can make decisions with that longer time frame, which is very helpful. In terms of the challenges we've got as an industry around the mutual side, the capital dynamic is different. So one of the things mutuals don't have is they don't have easy access to capital in a public sense. So you tend to find that mutuals are more conservative in terms of capital management, and we, I'm sure, like others, actually want to make every dollar of capital sweat. and that's very important. But we do make clear strategic choices because of that constraint on capital that non-mutuals don't have to the same extent. Scale's an issue for mutuals. They tend to be smaller. And so we have to be, as a sector within a sector, very deliberate about what competencies we want to have inside the organisation and what competencies we need to rely on others to support us with. We don't have the scale to have as many competencies probably inside as larger insurers. And that's very important. The cost of regulation is something we've got in common with everybody. And what we try to do is to weave it into our business, much as Cris was saying, to make it work for us. But having certainty, having consistency, and having a level playing field is very important for these investment decisions that we make. And we need to do that confidently. If it's a changing game, it's very difficult. Reputation, similarly, is similar challenges to others. But we don't have the same scrutiny probably as the publicly listed companies. I think one of the things with reputation is it is becoming more challenging with the social media particularly to try to control your reputation. That social media is very fast, and as Cris said, the media tend to prefer the downside rather than the positive stories. Affordability, yeah, look, this is an issue as well. I always think it's very interesting with affordability, There are two sides to the equation with affordability. It's what's the relative side of affordability. So if you look at the houses, someone talked about houses today. They're very expensive in Auckland. Now, that might be because the price of the house is expensive, or it might be because the income's too low. So when you look at affordability, it's the amount of money people pay for their insurance relative to something. So is that relative to household income, or is it relative to household spend? And maybe actually it's a perceived affordability issue, but the real issue is that household incomes in New Zealand are not high enough. The average household income is about $40,000. So I think hopefully the government is doing good work to try to improve the standard of living in New Zealand and household incomes. And that will help ease the burden in terms of how much people pay for insurance. I think it's very important that insurers, whether they be mutuals or publicly listed companies, and reinsurers get an adequate return on their capital. I really do believe that. They're taking a risk, and it's important that you get a fair ROE on that. And I think as an industry in behind that, and we shouldn't apologise for that at all, in my view, in behind that, we do play a very important role in terms of helping people with their risk appetite, not only understanding the premiums, but also the risk dimension. It's a very difficult thing to understand. We sell a promise at the end of the day, and so trying to help people to understand their risk appetite, as I think Cris, you said, being able to explain it clearly, providing good advice, good communication, good documentation, and good follow-through are all things that we can do that will help. And I think also doing a bit of stuff at the top of the cliff. We like to pride ourselves on paying claims. That's what we're all about. But to be honest, if we can put $1 at the top of the cliff and avoid a loss and all the grief that goes with that loss, not only the financial but the non-financial, that's $1 well invested. And as mutuals, we have a high accountability, as do non-mutuals, around that risk advice. I'll leave it there. Thank you.
Thanks, Cris, for giving us that perspective of the mutual, which has some commonalities, but obviously some differences as well from other insurers. Final speaker from the panel is Martin Kreft. We go back offshore again to the reinsurer world, and he'll be speaking to us about how do we keep New Zealand attractive to reinsurers, and do we risk being too small to matter?
Thanks, Tim. I feel a bit set up, actually. Tim asked me to give a reinsurer's point of view, and then I find out that there are two other reinsurers talking before me. So really there's not a lot I can say that hasn't been said before, perhaps. I'll just put one caveat on it, seeing we're being videoed here, that some of these opinions are Munich Re opinions, some of them are reinsurer observations, and some of them are mine. And just in case my boss watches the video, I'm not going to say which is which. And as Mo and Kent have really covered a lot of the reinsurance part of it, there'll be stuff that I'll say which is the same, like we established in New Zealand in the 1970s, and there'll be stuff that I've got to say which is slightly different, and I don't know whether it's something I should be proud of, but it is a matter of public record. But at 3 billion, Kent, mine is bigger than yours. So probably got to think, what, in terms of question 1, and I'll come to question 2 shortly and comment about that, but how do we keep New Zealand attractive to reinsurers? And I think in that respect we've got to say what does work for us and what doesn't work for us. And there's the global view of diversification, that we are not the US, we are not Europe, we are somewhere else. So yes, we are a diversification, we are another market for which a reinsurer can write business in. We have had good results over the years. I won't name the years that weren't good results, but we have had over the years, we've had some good results, and perhaps as Robert was alluding to, that if you take a very narrow annual view of it, and you look at it that the bouquet of the premium overcomes the stench of the exposure, we've done pretty well here until 2010. And I guess another one that's currently working for us, again, if you look at the premium side of it, is the actual exchange rate is working for us, particularly on a per risk basis at the moment relative to previous times. We've got stability here, we've got political stability, we've got relative economic stability, although David Parker didn't seem to think so. And I guess one of the other things that we've got here relative to recent history is we've got tax losses that go to extinction. So that's working for us at the moment. Regulation, we've got a light regulatory environment that works for us, and I guess from a New Zealand market point of view, there's a very low barrier to entry for reinsurers, really, in terms of the regulatory environment. And in terms of keeping New Zealand attractive for reinsurers, that does work. And I guess the other thing that we have going for us is that we actually have had, post-Christchurch, a measurable response. And that's been both in premiums and some of the conditions of the insurance that we now write in our market, which are different from what they were prior to Christchurch and which reflect lessons that have been learned from the Christchurch experience. What doesn't work for us? Size doesn't work for us. And that comes on to the next question, but I'll go into that shortly. Size doesn't work for us. For us, Munich Re New Zealand, we are 0.1% of the company's income. We're 0.1% of the company's income, and we have participated in the third biggest natural perils loss the company's ever had. So we're slightly out of balance, which goes to the other one, that exposure. Yes, we have significant exposure. And probably part of the exposure part that doesn't work for us is really our exposure is low frequency, high intensity. We're not going to get many earthquakes, but they will be big. And that does not work for us. And part of it then cuts into a little bit about what Mo was saying with this tail risk and modelling. We do have probably a significantly greater potential for inaccuracy in modelling. I won't say our models aren't good, but we do have a significantly greater potential to have modelling difficulty. So that doesn't work for us. Can we get that modelling better? I guess if you talk to a modeller, of course we can, and we're working on it all the time. So there are things that work for us, and there are things that definitely don't work for us, but I guess the main ones in keeping New Zealand attractive to reinsurers post-Christchurch has been the response that we've managed to achieve as a reinsurance market to New Zealand, to the Christchurch earthquakes. The second question that Tim asked me to address, and again another one I think I've been set up on, is do we risk being too small to matter? Yes. Oh, sorry, I haven't finished. Yes, we do run that risk. It is a very significant risk. I was discussing, what we could say with some of the colleagues in our organisation, and the only other thing they could say is there's 170 other markets that are exactly the same. But if you put them all together and you look at it as one, we're not too small to matter. So yes and no. I'll change it.
Thanks, Martin. It wasn't a deliberate setup. Our board members volunteered to go onto a panel about 3 months ago, and other issues were covered by other speakers, but thanks very much. Look, we've got a few minutes for any questions that people have. We've got a great opportunity here with 5 chief executives, leaders of our industry, talking about New Zealand, and we've covered off a number of critical themes that have been discussed today. So the mics are ready to go if we can spot 1 or 2 people who have got any questions out there. I know drinks are close and nigh, but I'm not sure that we've got a few minutes for questions. Okay, I can't ask everybody questions here, but let's just throw one up. We've talked a lot about reinsurance, so I'm going to sort of steer back onto perhaps reputational matters. We've been suffering some bad press, and I guess my challenge to all the speakers on the panel is to, how do we make insurance, sex it up? How do you make insurance a sexier career? How do you make insurance more interesting for people out there? Because, the stereotypical view, I think, is that we're there in glass towers, we're multinationals, but we're not there at the ground. And I just wonder whether that stereotype is one that we can take to bits and make our industry interesting and one that people really want to be part of. So whoever wants to start off, Jacki, I think you might have some things to say there.
I think the interesting challenge is that once we get in it, it is very interesting, and we've all stayed in, many people in the room I've known for many years have stayed in our careers in the industry. So the problem isn't about do we have to make it different once we're in it, it's about the public perception. And I think about what all my colleagues, myself, are doing in terms of Christchurch, in terms of taking the leadership, often across not only our industry but other cross-government departments. We're actually showcasing the way of the future about how you can collaborate to get good outcomes. And I think when you think about different generations and what they want from their career, the very fact that we're able to showcase that. I must say we've had some very interesting discussions as a board, and very recently about, we know a lot of the information about what's getting stuck, and we constantly have to recalibrate about what's our risk appetite, and because we all have to talk about risk appetite in our own organisations a lot, we've had some very considered conversations about how much do we take personally. I mean, there's several of us on the panel who have been described in the media as beyond immoral, and I think that's sexing it up. If only we were having that much fun. But when you're taking those hits, and they're very personal hits about, and I wasn't included in the statement that was talked about the men in suits in Auckland. I pointed out to Gary Dransfield that he should start wearing skirts and then he wouldn't be able to complain. But, they're the things we're encountering, and I think what we have to do is show that we are a very collegiate group. Yes, we're very competitive in the market, but the way we work gets solutions. When we've had the risk appetite discussion, if we go to war and start blaming everyone else, will we win as an industry in the eyes of the consumer? And does it then look like everyone's fighting and then everything's more hopeless? But it's a very considered thing. So we actually do have a lot of conversations behind closed doors, and then we chair meetings where we actually hold people to account. Usually in my career, I haven't seen us do that as an industry, but I have here, and I think that it starts at the top in terms of the ICNZ board, how we behave, and then right back into our own organisations, how we expect people to behave in our industry, and showcasing the reputation that we are building, but knowing that once we get in it, we've all got pretty exciting careers to offer people, and make sure we're investing enough in development plans and also in the cultures of our organisations.
best places to work in this country. So that goes to the heart of culture and engagement of our people. And I just think that for whatever reason we haven't been able to get that message out beyond our own industry. We all know how good it is to work in this industry. We all love it. But we've got to do something different in terms of getting that message out there, because the credentials and the foundation is there, we just haven't got the story through. So I think we should be very proud of how our people feel about working here in this industry.
Yeah, just on building on that, is this working? I remember seeing a study a few years ago where there was a comparison between a major domestic personal lines company in the United States, which was considered to be one of the best service providers. I won't name them because I'll probably get it wrong, but they were compared to Apple. Can you imagine the comparison? And there was a survey that was conducted with people about, which company was the most racy, which one contributed most to the economy, which one contributed most to employment, and what have you. And it was hands down that the insurer won this, okay? But the perception was that it was actually behind Apple. And what I think we have to get across is that it's not only that insurance is a necessary function of what we do in an economy, it actually underpins the basics of what needs to happen to have a developed economy. And that people can be a part of that when they join the insurance industry. And if you look at the breadth of products that this business offers, there is a huge amount of career possibilities for people to get involved in anything from tangible to intangible areas of the economy, businesses, know-how, knowledge, HR, finance. The list goes on and on. So we've got a great opportunity to really showcase insurance as a really viable, long-term, sustainable career for people, but also to try and do what we can to talk it up, to actually be as interesting as it actually is, because I think that perception issue is really at the heart of it.
Any other? Anybody got any other questions that might have been prompted by the comments that have just come through? Or?
Paul, over there.
Cris, Curtin, you talked a bit about the importance of increasing the awareness of the importance of insurance in the community. And I just wonder whether we should be doing more within the schools process to just generally increase, I guess, financial literacy, so that kids, when they come out into the community, they understand the importance of saving and the importance of insurance, because like Cris, you were saying, it is sitting behind everything that's happening within the community and allowing the economy to work. So how can we be sort of in that education process maybe to increase awareness that way?
Good question. I agree that education is a really big part of this. And I mean, when my talk was about affordability, so I didn't want to give people the impression that it was just about the price of buying the products. It was very much about the value that we provide across the board. So, look, to be honest, if we really have a good cold hard look at ourselves in the industry, we haven't done a very good job at that. So whether it's getting into schools, whether it's getting into
one of the things that I mentioned this morning was that we are partnering with the Retirement Commissioner who has responsibility for financial literacy to try and get it into schools. In our board strategy session earlier this year, we discussed the opportunity of doing it ourselves as an industry, and I think the reality, and for everyone who has kids at school would know, the curriculum gets pretty full. So if every industry started to try and load the curriculum, we wouldn't get much traction. But Tim has done some good work with the ICNZ team where we've been able to open the doors to have the discussion of how it will actually be backed into the curriculum through the financial literacy program. And as Cris said, it is very confusing that we have 3 Chris's on the board, I must admit. But we actually do need to make sure we keep that dialogue so that we can be incorporated and then we can leverage on everyone else's efforts. But it is something that the board has seen as quite important.
Okay, any final question perhaps from anybody? Cris, you mentioned something about a level playing field, Cris Black. Just wondered whether you wanted to talk to that level playing field in terms of how insurers, whether they're mutual, New Zealand owned or whatever, whether you think there's a level playing field of treatment there. And I guess for Chris, Knell, what's the case for different treatment for different entities, given they have different capital structures, different sizes, different makeup?
Shall I kick off then? Shall I go first? Yeah, I think as Jeff was saying this morning, the objective of regulation is to do 2 things. One is to ensure the soundness of the industry, and secondly is around efficiency. And he used the word balance a lot. And I suppose the question that we'd ask is the balance right between ensuring the soundness of the industry and efficiency? Because if the capital arrangements are... he wants to answer the question. Right. I think the industry is very sound. I mean, that's been, we've got 99 insurers. We've got a huge number of insurers. Yes, they don't all make it. But to be honest, there's plenty of people that will take over the portfolio. So in terms of a sound industry, I think it's very sound. And I think that's been demonstrated through a number of decades. So I'm not sure one needs a regime and a capital regime behind that. It's too onerous, and if it is, then the industry becomes very inefficient. And there is a lot of regulation and costs that we try to weave in, but the reality it's a cost of doing business that will be passed on to the consumer. And we don't want regulators running around with solutions looking for problems. We really need to understand what the root cause of what the problems are first before we start fixing them. You're going to say something different?
No, I think it's perfect. Next. We used to rely on the rating agencies an awful lot. We looked at the rating of the companies in the United States, across Europe and what have you, and if somebody had a AAA rating, as a few reinsurers and AIG did at one time, they were seen as being absolutely bulletproof, and people took that at face value. Clearly the rating agencies have gone through some changes themselves as well, and I think the regulators have recognised that that's not a cornerstone to rely on as well. So they're looking at revising the capital frameworks for companies. Even in Singapore, our parent company is managed out of Singapore through the MS. There's a new risk-based capital forum which is coming
for all of us in terms of having a little bit of discipline towards us as well. Okay, thanks very much. We're through with questions, so we'll be moving on to the drink shortly. I just want to say that everybody on the panel here, they're leaders of their own companies. They have very busy lives, but they give of their time for our industry. They sit on the ICNZ board. They come to opportunities like this, and I just would like you to join me and show our appreciation for the time and effort that they put in.